From the studio at Allied headquarters, this is the Allied Angle, where we take an in-depth look at current market trends with industry experts. I'm your host, Amber Guthrie with Allied Solutions. Today, we're unpacking what we're calling the new risk stack, how fraud, insurance gaps, and a strained recovery system are stacking on top of each other and quietly compounding losses across auto lending. Next on the Allied Angle. Welcome to the Allied Angle, your auditory complement to Allied Solutions e-newsletter, Allied Insights. Joining me today is Anne Holtzman, Senior Vice President of Risk Management Services at Allied Solutions. Anne, thank you so much for joining us today. Well, welcome back. I think this is time number 3, maybe?
Yeah, at least. It's wonderful to be here, and thanks for having me today, Amber. Really appreciate it.
Of course, anytime. So just a reminder about who Anne is. In her role, Anne leads product development and builds strategic vendor partnerships to deliver risk management solutions for all areas of lending institutions. She brings over 30 years of experience in the insurance industry, having held executive positions in both personal auto insurance and financial services. Anne is especially known for her deep expertise in recovery, including repossessions, total loss, and gap claim recovery. She earned her Bachelor of Applied Science in Finance and Financial Management from the Scott College of Business at Indiana State University. All right, Anne, so as you know, we like to do a few icebreaker questions before we get to our real conversation and what we like to call the Allied Angle Accelerated Q&A. Anne, are you ready?
I'm ready.
All right, question number 1, and this is perfect for our conversation. What was your first car?
Oh, it was beautiful. It was an orange Ford Pinto.
Ooh.
Oh, yeah. And if you remember right, they used to explode if you hit them in the back.
Oh, no.
So my parents' guidance to me was not to stop short because the car could explode. So just make sure that I gave folks plenty of notice when I was going to stop.
Or was that their way of making you drive safely and just kind of being aware at all times?
Could have been that too.
All right, so question number 2, what is your favorite memory?
Oh, my favorite memory. Wow.
Or maybe top 3.
Top 3, definitely the birth of my 2 children, absolutely. And then my marriage to my wonderful husband, Greg.
Aw, still very sweet. All right, so 2 questions that we ask everybody. The first one, cats or dogs?
Oh, absolutely dogs. Yeah.
Do you have a dog?
I did. I lost him about a year ago, but he was an awesome yellow lab named Cooper. And
Cooper.
Yeah, he was amazing. So eventually I'll convince my husband we'll get another dog, but not right now.
You have to.
Yeah.
You're amazing. All right, and our last accelerated Q&A question, what is the best piece of advice you have ever received?
It's from my father. And he said, when I first entered my career and I started accelerating into different management positions, he said to me, just always remember, on your way up the ladder, you're going to meet a lot of people and you're going to handle yourself a certain way. Just understand those people will still be there when you're on your way down the ladder. So, don't get too full of yourself.
And treat everybody with respect, same way. That's amazing. I love it. All right, well, now we can get into it. So risk in auto lending used to come down to one question: did the borrower pay? Not anymore. And you're talking with risk and lending leaders every day, so you have a read on this that most of us don't. Risk doesn't look the way it did even just a short while ago, and instead of one problem, we're seeing a bunch of them landing all at once. So let's start wide. When you are talking with FI leaders right now, what feels meaningfully different about the risk they're managing compared to just a few years ago?
I think it's the larger exposures and the amount of the dollars involved in the risk. So when you think about vehicle prices, when you think about home prices, you're looking at folks too with constrained resources. So things that are unsecured like credit card and home equity lines of credit, you're seeing a strain financially that is creating larger financial exposures. I would say that in and of itself is number 1. Number 2 would just be resource constraints, whether that's within the collections world, whether that's repossession and recovery, whether that's REO property management. After COVID, 35% of those resources, and a lot of folks that chose collections as a career left that industry because there weren't jobs. And as a result of that, it's taken us this pretty significant period of time here to bring those resources back. So I think resource constraints, and the inability to optimize the processes. Number three, it's got to be the emergence of fraud. And that might actually be number two. With a lot of digital lending, the ability for things to be done electronically versus the way states used to manage things like titles and foreclosure notices, things like that, insurance carriers going digital, we're missing a lot of information. And so that is allowing folks to work the system and create fraudulent loans. And I think the emergence of this fraud is probably top of mind for a majority of lenders. And then lastly, the need to digitally engage with their membership or their borrowers. Folks aren't picking up their phones. We all block our cell if we don't know the number and where it's coming from. And we are used to a self-service environment now. And so when you think about it, in order to write a delinquent loan or to make a payment or to pay past due or to communicate, they want to be dealt with digitally. They don't want that phone call. It's interesting, right? The dynamic of not wanting to have that human interaction. And I just want to respond digitally. I would say that is something that we've seen crescendo over the last few years.
So it really seems with the rise and the entrance of all things digital, just layer upon layer upon layer of additional issues just kind of added up here. So with the rising cost of ownership, borrowers are really feeling it from every direction. And one of those pressures is insurance. It usually gets filed under coverage and forgotten, but you've described insurance as one of the earliest signals of borrowed trouble. Why does a lapsed or unaffordable policy tell you more than a missed payment does?
It will be the leading indicator to a missed payment. So what you will see is a set of actions by that borrower that basically say I'm in a financial strain. So when you think about just cost of insurance, and I've been in the industry, next year it will be 40 years. I will have been in the industry. I've not seen the year over year increases in premiums like we're seeing today. And so, 20% of all drivers are uninsured. 50% of all policies at any one time are being shopped for a lower rate, higher deductibles, less coverages. You've got a 15 to 24% year over year increase in insurance premiums. And so all that is leading to an affordability issue. So what will happen is you will see borrowers increase deductibles, first signal. So if you're tracking insurance and you get a high deductible report, that's something you probably want to pay close attention to. That's the first sign. The second sign is lapses or canceled coverage. So they will lapse or cancel that coverage 90 days before, generally, they stop making their payments. So if you can look at those high deductibles, that lapse and canceled coverage, what is that loan to value ratio on that vehicle? That should allow you then to have earlier conversations with borrowers around this financial strain that they're having. You can also probably see it in overdraft checking. You could see it in a missed payment on a credit card. So there's a lot of early indicators, but Allied tracks 23 million auto loans. What we know is when we see those lapses or canceled coverages, 90 days later, we see the financial institution report that as a potential out for repossession vehicle. So again, I think there's an opportunity to leverage information that lending institutions are already receiving, but leverage that in a different way.
Would you recommend so many warning signs before action is taken? Kind of we've seen a missed payment, we've seen an overdraft, we've seen something else, and then jump in? Is there kind of a guideline to follow?
I think it's any of those. A courtesy call, a courtesy reach out via, a text or a digital engagement. I think any of those are great ways of figuring out what's going on. I think what's also important is In today's market, people are walking away from vehicles. And I know we're going to talk about that later in the podcast. You want the opportunity to potentially do a loan modification or possibly, do a complete rework of that loan before what they do is go and get an auto loan somewhere else and then tell you to come get the car. So I think any of those early indicators are a great way to reach out to your member. Do you need to do a refinance? Do you need to do a loan modification or a rework of a loan versus have that person just tell you to come get a car with a $9,000 deficiency balance and negative equity, and they've already secured that loan with a different institution. So I think there's a number of ways that you can prevent and keep that member or borrower.
So really focusing on being proactive instead of reactive with it.
Absolutely.
Well, and actually, we are jumping into the voluntary surrender right now. It seems to be a newer trend that we're seeing, this voluntary surrender, where instead of just falling behind, a growing number of borrowers are choosing to walk away and hand back the keys. So, Anne, what is driving that shift from can't pay to won't pay? And why should it change how an institution is reading its own portfolio?
Yeah, I think that we're seeing, at least in, let's say, the credit union marketplace overall, you're seeing an average voluntary rate north of 20%, just on average. That was 5 to 7 to 10% just, 36 months ago, 60 months ago. The truth be told is the vehicles that they're voluntarily giving up, they normally have a significant deficiency balance, meaning they're $9,000 to $11,000 underwater in a vehicle. They know it. That payment isn't matching the vehicle that they have. So they are looking for outlets in which to give back the vehicle. And more than likely, they will do that after they've secured a loan and secured another vehicle elsewhere. And some it's just a pure affordability issue. And they're saying, I can't afford the insurance, the maintenance, the vehicle, the interest rate. So I think as we look at this trend, this voluntary surrender, as lenders are approaching that, understanding that you then have to be very proactive in how you're going to manage the liquidation of that collateral and all of those claims and product cancellations that follow, because you're more than likely getting a deficiency balance or a vehicle that's underwater already, or else they wouldn't be voluntarily giving it up. And I think part of it too is growing up, again, older lady here. It was unheard of that I would walk away from a car payment. Mm-hmm. I think younger people have a different mentality towards that. And I'm not saying that's good or bad. I'm just saying there has been a culture shift around, the ability for them to maneuver something financially that allows them to still have a vehicle, but voluntarily give a vehicle up for repossession. Now, there's always, tailing impacts to that financially or on your credit report or all of those things. But if your immediate needs are met, then you are probably more than likely to say, I just can't do it. I'm going to walk away. And what I've seen with financial institutions is a very respectful approach to that, and accommodating members and borrowers when they do need to make that voluntary surrender. However, anything you can do to prevent that, you're better off that they remain in the car and continue to make payments, or you find a refinance or a rework that would allow them to remain in the vehicle.
So it's a very interesting point that you made about how an older generation, you would never think to not make your car payment, but kind of the younger generations are thinking a little bit differently. Do you have any thoughts as to why that shift has taken place? Just the mental thought behind it?
A lot of it's this digital engagement, right? Everything they do digitally. So I remember, right, I would go to the car dealership. I would meet with that dealer. I knew the financial institution. I went there to the branch. And so there was something about that that I would never want them to know I couldn't make my car payment, right? Two, we didn't have an instant satisfaction world. Like I recall when I went, when I didn't have my Ford Pinto anymore and I was going to buy my first car. I mean, I saved and saved and saved, and I knew what I could afford, and I didn't get in over my skis on that. And I knew it wasn't the car I always wanted. It was the car that I needed. And I was laughing the other day with someone that my first two cars, even in a professional environment when I was driving all over the place, didn't have air conditioning. So I'm like, I remember being in full suit, skirt and jacket, blouse, high heels, and I'm driving around in a car without air conditioning. Like, what I mean by that is, with our kind of world of instant gratification, buying a car without air conditioning or just the basics, that's not really in our DNA any longer. And then working up to that car of your dreams, right? Or home of your dreams or whatever. So I think we've lost a little of that.
When I would think too, in this digital world, it's that plus the keeping up with the Joneses mentality of social media where, everybody has the picture perfect life. So when you see that, you're like, well, I need the nice, big, fancy car and I need it now.
Right.
I don't want to save for it.
Right. Exactly.
All right. So you touched on this just a bit earlier, but let's bring fraud back into the picture because most people still think of it as a one-time thing that happens at the application. But you're seeing it behave more like a thread that runs through the entire life of the loan. How does fraud that slips through at funding end up resurfacing and compounding cost at the recovery stage?
So a lot of what we're seeing are lost liens, meaning that whoever took out the loan, it's usually a first to third monthly payment default. And by the time the lending institution tries to perfect the lien, they have washed the title and that vehicle's been sold to a consumer that had no idea that they were buying a vehicle on a wash title. When you talk to lending institutions today, title washing on vehicles and lost liens is probably one of their largest areas of fraud as far as that lending track goes. So when you've lost your lien and you have no ability to have proper title to a vehicle, you then can't repossess and liquidate that collateral. So you have in essence made a loan that is owed to you. The asset is no longer yours and you're out the loan dollars that you have provided on that particular asset. So this whole title washing thing, and it really has happened because of e-titling within the states. Used to be, right, registration, title, there was a process for it. Now we have this e-titling, and when people go in and have the ability to hack titles, the ability to hack information, and then title wash those before the institution can perfect their lien, we're seeing a lot of that today. And certain states are more rampant than others, and it's really how they have their e-titling set up. I think second of all, when you have that first to third to fifth to sixth payment default, you need to apply a different collection practice to that than you do someone who's been with you and paid for 24 months. I'm not necessarily seeing that across the industry. It's nope, our process is we look for it for 30 days, then we'll, give it to a skip tracer, and then we'll, maybe put some license plate recognition on it. When you've got defaults within the first 6 months of that loan, the chances that there could have been fraud are much higher than they are if someone's making payments for the next 24 months. I think that needs a different strategy, and you need to be skip tracing that vehicle right away. You need to make sure that if you haven't perfected your lien, you're getting that lien perfected very, very quickly. And I think lien perfection in and of itself is an industry problem, and it's really a state problem. We don't have a national system for lien perfection, so you got to go by every state, and it's as good as how that DMV in that state is being managed. Vehicle alerting, impounds, exports, total losses, those are really important. as well. So there can be some proactive vehicle alerting solutions out there. Historical license plate. Start running that vehicle with historical license plate from the date in which you, or inception in which you board that loan, because you can do things like run that information. There's an address correct product out there where you can validate that that borrower's address is actually a valid address. We see in these cases of fraud, they didn't even give the lending institution an appropriate address. And lastly, strong dealer contracts. The dealer has an obligation to follow the contract when you, the lending institution, have given them the power to make deals on your behalf. When they do not follow those practices and you have fraudulent loans, those dealer contracts are all you have for recovery back against that dealer. I will say this, as an industry, credit unions versus auto finance banks, etc., do not necessarily treat these dealer contracts as aggressively as they should or could. Now, I'm just, letting us know today on this podcast, the other financial institutions are. So are you really at a disadvantage to not enforce those dealer contracts on fraudulent loans? Probably not. But understand there's a relationship there between credit union and dealer. But I can promise you, if you talk to auto finance and banks, they're enforcing those dealer contracts all day long.
So are you officially giving credit unions the okay to be a little more forceful?
And I think you've got to put teeth in it. I think you've got to put teeth in those contracts around fraud. I would say lastly, there's some really new emerging products. Allied has one through a partner that is combating fraud at the time of loan origination. And it, at least initially, shows some significant promise in what we're talking about here, which is this first to third payment loan defaults and fraudulent, borrowers. And so looking for those products and reestablishing what you're going to do at the time of loan origination to eliminate that fraud or at least minimize it, I think that's the first step before you ever even get to the recovery end of the process.
Do you find that a lot of lenders are looking for changes and a better strategy to deal with this, or are a lot of them just kind of like status quo, it's the way to go, and we're just going to keep on keeping on?
I don't think so. They recognize that this digital engagement and everything being digital now, is wrought with this fraud. And quite honestly, the folks that commit this, they're very sophisticated. So it's not a point in time problem. It's a market and economic problem. And I don't think anyone believes it's going away. So these emerging products that attack this fraud at the beginning, I think are going to be critical because folks committing these frauds are already out ahead of, those of us sitting in the financial institution industries. They've already figured out how to do this. So I think in talking to most institutions, their strategies to approach the reduction in fraud are, a priority, a strategic priority.
So now we've got affordability strain, insurance gaps, fraud, and borrowers quietly checking out, all on the table, all at the same time. They don't just add up, they multiply. So by the time a vehicle actually enters recovery, how much of a loss has already happened, and where exactly does it happen?
Really, it happened when there was the first payment default, like that first, delinquency payment. And honestly, when you think about it, depending on what insurance program you have, it could have started there because, you're placing that insurance on, which we're seeing much more of a demand for, whether that's a blanket policy or a forced place policy, because if you have 20% of folks driving around at any point in time uninsured, that's a large risk for the financial institutions. So we're seeing forced placed insurance, blanket protection, order up insurance, we're seeing that at a much higher demand today, which makes sense because if the voluntary market's not affordable, the financial institution needs to protect the asset. However, the moment it goes into delinquency with an average deficiency balance now approaching $11,000, there's your loss. So I need to figure out how to minimize that $11,000 hit to my organization. And how am I going to do that? Well, I need to have faster recovery. I need to have the ability to transport collateral and liquidate it with optimized results. I need to ensure that I do not miss a single claim associated with that collateral, whether that's physical damage or skip or even total loss adjudication, and ensuring that that's accurate. And then I need to make sure I'm filing my indirect gap claims. When we leave that to borrowers, normally it may not happen in the 90-day period that's necessary. So we need to make sure as institutions we're filing those on their behalf. And then lastly, product refund. So regardless of state statute, in all 50 states, repossessions, total losses, you have an obligation to cancel those products and bring those funds back against the loan. So when you think about that, if you can then optimize all these recovery areas of the process, you can start to whittle that $11,000 deficiency balance. You might be able to do it by as much as 50%. You might be able to do it as much as 80%. Well, that's critical because that means I'm not writing off and charging off $11,000 that I'm probably not going to get back. 3% of the industry can collect on deficiency balances. So that's just average. So 97% aren't collected. So you don't want to be out that full average of $11,000 per unit.
Now, this is the question everybody's asking right now, and I know you've heard it. Can't AI just handle all of this? So, Anne, I have to ask, can't AI just handle all of this? No, but seriously, where does it actually help an institution see risk earlier? And where would you caution leaders not to hand over judgment?
AI can help you identify proactively where risk might be, but it's still a human interaction. It's an art. It's not a science. And when I think through the entire process, there is still a human aspect to all of it. And so you need to have a human voice, a human process that allows you to better take maybe some of the analytics and turn those analytics into strategy or initiatives. AI isn't going to do that for you. AI isn't going to help you choose the right partners and the right products. They might recommend those products to you, i.e. you need a skip organization, or you need license plate recognition, or you need a better way to liquidate vehicles, or there's improved processes that you could do through that. What AI isn't going to be able to do is to make sure you've got the right and proper products, partners, compliance, and financial impacts of those products and partners. And AI cannot tell you whether a product or a partner is going to protect your brand. And so, again, great in the analytics, great pointing you in the right direction, great probably in determining what loans to identify for delinquency or potential delinquency, but it's going to take human beings, financial institutions, products, partners, to do what needs to be done to execute on where those analytics are pointing you.
I feel like every time we talk about AI on this show, it comes back to the same thing where AI is a tool. It's not a whole solution.
Absolutely. And there's great pieces to AI in this space, 100%. that digital engagement that we talked about, and they're actually talking to a bot, but it seems like it's a real person. That interaction, that digital, it's great, right, for certain situations. But again, you've got to have the infrastructure of the processes and the products. And that isn't something that AI would give you.
So, Anne, let's bring this home. Let's land this plane, or maybe in this case, we should park the car. I want to leave our listeners with a final thought. What's one mindset change that separates the institutions getting ahead of this from the ones stuck reacting?
I think one is using their tools. So many institutions track loans. There's a lot of tools in that loan tracking system that give you a lot of proactive information. Have you adopted that and the use of that data in a way that can assist you? I think second of all, know your competencies. You're really good at lending. You're very good at managing accounts. You're very good at dealing with your consumers. You're good at those, reach out calls. But are certain services that are done in a lending institution, are you an insurance expert? Are you a repossession expert, remarketing expert, title expert, claim expert? Those are competencies that you could outsource. And so I always say know your competencies and also know where your strengths and weaknesses are and where you may have areas where your time is better spent serving your institution because of your competencies. Find then a very competent product partner and product solution that can help you manage areas where that may not be your core competency. And I think the institutions that we work with at Allied Solutions who draw that line between these are my competencies and what I can do very efficiently, effectively, and in an optimized way. And here's what I cannot do. In those same veins are the ones who are kind of ahead of the game right now. And I think you've got to be willing to try solutions. It might not always work. When we think about it in this environment, new and emerging solutions are going to be there. Take those for a test run. You don't know until you try. Mm-hmm. And I think that trying and figuring out how something works for you is a benefit. And then lastly, deal with a partner who's willing to boutique solutions to match your institution. It's not a one size fits all. Everyone has a different culture. Everyone has a different footprint. So where can you find products and partners who are willing to meet you where you are and understand your institution so that you can optimize processes that maybe are not part of your core competency?
Well, Anne, thank you so much. You're always showing up with great advice and information, and we truly appreciate you coming on the show. So if you enjoyed and found something out of today's conversation, be sure to share it with your network and hit follow or subscribe wherever you listen so you never miss an episode. And we will see you next time on The Allied Angle.